Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. In this video, we are going to discuss the CCI T3 Divergence Indicator. Alright, it's quite a unique indicator and I'm just going to write the name here on the chart so we can see it clearly. The CCI T3 Divergence Indicator. All right, so I'm going to add the indicator to the chart right away. It's a custom indicator, meaning you have to download it from an external site and add it to your indicators library before you'll be able to use it on your chart. So it's quite a straightforward indicator. All right, it's an indicator that is based on the commodity channel index and triple MA. So the CCI is coming from commodity channel index, while the T3 is coming from the triple moving average. All right, the triple MA. So the indicator tries to combine the technologies of both, the CCI and the triple MA. So this indicator aims to simplify trading by automatically identifying both hidden and classical divergences. So as we can see on the chart, this indicator is quite a divergence focused indicator, right? The indicator tries to identify both hidden and classical divergences, so it makes it easier for you to analyze market trends. Okay, so basically when a bullish divergence is detected, you're going to see green lines, as you can see here, right? These green lines are indicating bullish divergence, right? And you know what bullish divergence means, right? When the price is making higher highs, and then you have the indicator make lower highs, and then as a result of that, you likely have a bullish move. That's a bullish regular divergence, right? So as you can see, that about this point, we can see that the indicator, the CCI, the CCI part of the indicator, we can see that it's somewhat made lower low around here, but we can see that we had the price itself make a higher low, right? We can see that the indicator itself, the price itself made a higher low, while the indicator itself made a lower low. Okay, we had a lower. Okay, that should be for the bearish. That should be for the bullish hidden divergence. That should be for the bullish hidden divergence, because bullish hidden divergence shows a continuation pattern, right? It shows a continuation pattern. Bullish hidden divergence is when the price is making a higher low, but the indicator is making a lower low, showing that a bullish momentum could resume. So we actually had a bullish hidden divergence around here. That is the reason why the indicator gave us a green line, okay, because it's a bullish hidden. You can see lower low here and higher low here. Then in this case, let's just look for a bearish example, because this is still a bullish divergence. So let's look at a bearish example. Let's see if we can find one real quick. Okay, let's look for a bearish example, right? Okay, we can see that at this point, we had a bearish regular divergence. This should be a bearish regular because the price made a higher high, right? The price made a higher high, but the indicator made a lower high. As we can see here, the indicator made a lower high. So that is an indication of a bearish regular divergence, okay? A bearish regular divergence occurs when the price makes a higher high, but the indicator makes lower high, showing that bearish momentum is building up. So we can see that right after that, we actually had a decline, right? We had a decline, and you can see the red line that formed. You can see the red line that formed, giving us an indication of a bearish divergence. Now, in addition to the divergence signals by the CCI T3 Divergence Indicator, we also have arrows form, right? The formation of these arrows tell us the possible direction at that time, the possible price direction at that time. Okay, so as we can see that here we had a bullish move, and then right after that we had a bearish move. But if you are a swing trader, I wouldn't exactly recommend using the arrows, to determine your entries and exit, because you can see a lot of arrows appearing just within the space of how many candles, right? So if you are a scalper, it's fine. If you are paying attention to the arrows, it's actually fine. But if you are, and by the way, you can see that the arrows sometimes may tend to even give you more false signals compared to the divergence itself. So I will recommend focusing on the divergence indicates in the indication, right? I'm going to recommend focusing on the divergence indication rather than the arrows, okay? So whenever you have the indication of a bullish divergence, what you should be looking out for is buy opportunities. As we can see, the indicator made it easy for us to interpret what divergence it is, bullish or bearish, with the lines. So when you find a green line, you already know it's a bullish divergence. So look for buy entries, look for buy signals. Whenever you have red line, you already know it's a bearish divergence. You look for sell signals. So in this case, having found a bullish divergence, we should be looking for buy opportunities, and we can see that we had a buy opportunity somewhere around here, right? Because we had a bullish engulfing pattern form around here. And then I'm also going to recommend making use of trend lines and horizontal support and resistance zones, because they're going to serve as good confirmation tools for you. They're going to show you potential reversal points. They're going to give you insights ahead of time, right, as to possible places where price could reverse. For example, we can see that this resistance zone gave us an insight that this particular place is not a good place to buy, right? In as much as we already had a bullish divergence forming, but because of this ascending triangle pattern, it is better to wait for a breakout before entering a buy trade. So if we eventually have a breakout from this point, perhaps you have price go up and then we have a retest. Remember that retest is one of the ways to validate a breakout. So after we have a retest and then you have a continuation in the direction of the breakout, you can then go ahead and enter your buy trade. So after the breakout happens and a retest forms, and then you have a continuation, then you can go ahead and enter a buy trade. All right, but if we eventually have a breakout to the downside, then you should look for sell opportunities. All right, now in the case of a bearish divergence, whenever we have a bearish divergence, also watch out for chart patterns, watch out for candlestick patterns, watch out for support and resistance zones. All right, so whenever you have a divergence, a bearish divergence form around a resistance zone, that's even going to be a better time to enter a sell, because it means that there is a higher chance of a bearish reversal happening for the fact that the divergence signal came around the resistance. So in that case, you can consider entering a sell, setting stop loss above the swing high, and your take profits can be at support zones, right? Your take profit can actually be at support zones, or you can decide to use other indicators for your confirmation. All right, now whichever way you decide to determine your exit strategy, ensure that you always employ proper risk management. Okay, do not trade with an amount that you cannot afford to lose, and do not risk more than 2% of your account balance in a single trade. And also ensure that you use good risk to reward ratios. All right, for example, if you are risking a dollar, you should be targeting to make at least $2 in profit. Okay, so that's going to give you a risk to reward ratio of 1 to 2, risking 1 to make 2, right? So that is it for this video. I hope you found this video insightful. Kindly like and subscribe for more trading insights, and don't forget to hit the notification bell so that you do not miss out on more trading videos like this. In the meantime, thank you for watching, and I wish you a happy trading.